Welcome to our quarterly investment update for April to June 2025. Markets that bounce back, but what's driving it?
Markets are up in your life. That's right. It's our quarterly market update where we talk about what's been going on from April to June. And we're also using this for our investment clients. Mike, Trump is probably the theme. And markets are back up.
Yeah, they are. I mean, if we start on the Trump side of things, and, James, you are going to the States very soon. So potentially you do want to watch what you say. You might not get let in at the border.
It's funny you mentioned this. So when we were doing our visa, there is like a please disclose your social media stuff.
Oh, no.
And Hannah goes, with the podcast, have you said anything bad about Trump? And I was like,
Not
well,
really.
I just said he was a round orange man with small hands. So I'm sure we're fine.
Well, factually correct. I'm sure he'd love that description. So it is, he is a massive theme in almost everything that's going on globally at the moment, and the markets are no different. The really big thing that he's done, though, which is no surprise to anyone, is the tariffs.
I thought you were going to talk about the UFC card for July 4th next year.
Why? What's happening there?
I've told you about this last
on the
time.
front lawn.
Yeah, they're just doing the UFC card on the front
every
lawn.
now and then, I'm like most of the stuff he does, I'm like, oh, damn it. And then every now and then, I'm like, he's just having fun.
Isn't it the most American thing you've ever heard of?
Oh, yeah.
Fighting on the front lawn of the White House.
It would only be more American if it was Kid Rock introing Stone Cold Steve Austin coming down into a WWF ring. That's the only way it could get more American.
I'm pretty sure Kid Rock has a Kid Rock, Elon Musk probably out. Kid Rock, Elon Musk, and Trump have like a group chat.
Oh, what I would give to be in that. But yeah, look, the tariffs were the big thing, right? And we're putting tariffs on things. We're taking tariffs off. We're negotiating on this. We might have a deal over here. We've got this amazing deal with Vietnam over here. James, cut through all the noise. What is happening with these tariffs?
So my new favorite expression is taco. Trump always chickens out. And so when he announced the tariffs, markets dropped about 20%, which was pretty bloody scary at the time. So I'm going to bring up a graph and we've got a few graphs today. So
you're all lucky.
Yeah. So if we look, so this is 2025, the share market performance. The blue line is the world index excluding the US. The orange line is emerging markets. The yellow line is the US markets. And the green line is the New Zealand markets. We can see they all fell off a cliff around between April and May and then recovered quite quickly off the back of it. Mike, we know why they went down.
Yeah.
He said we were going to chuck a bunch of taxes on everybody. Why did they go back up?
Well, he did put some taxes on some people. Maybe it's still coming. Maybe it's not. Effectively, what happened was he backed out of his initial negotiation position. And there's two kind of schools of thoughts on this. One, he goes really hard, anchors everyone over here and then comes back and everyone accepts the deal. Or he actually does do that. He just chickens out when he goes, hang on a second, I've said something here. There are some wider ramifications that actually I'm going to blow everything up. This isn't going to work, right? So at the moment, I think it's like roughly sitting around 10% for everyone is basically what's going to happen.
Well, and China came back quite strongly, didn't they? They were like, we're just going to, what were they doing? Like 60, there was 60, 100% tariffs getting thrown around.
Yeah.
And China was like, we're not backing down.
Yeah.
And that could have led to a lot of pain, not just for those two countries. And it seems like China not backing down has meant Trump's chilled out a little bit.
Well, I think you've just got to think of the two ways that the governments operate and who can be more staunch, right? China will literally let people starve to not back down, right? Trump doesn't have that option, right? Even already we're starting to see signs of maybe he's not doing what he said he would do, not quite happy with what's going on. Maybe it's a bit extreme here. China doesn't really care about that, right? They'll let buildings go empty. Crops fail, they won't sell stuff, they'll dump stuff at a lower price just to hold on to that point.
Yeah, so if we come back to this graph, so we've seen the markets have dropped. The really interesting thing, Mike, is you can see, say, the world market excluding the US, that's up now 10% year to date. Emerging markets is up about 10%. US is lagging very far behind, just slightly in the positive, around 2%. And New Zealand, we still are in a world of pain. And while we went down about 10%, we're still about negative 1.5.
Yeah, look, not great news story in New Zealand with our economy at the moment. But the market, right? We said everything's up, everything's looking rosy, everything's looking green. Talk me through that. Why are we in such a bad place, globally, or such an average place globally if things are going up?
So year to date now, we're actually looking pretty good. At one point when we were down, 20%, that wasn't much fun. But most years will have a 10 to 20% drop in them, even if they end up positive and quite strong.
Yeah.
So essentially the story is this quarter looks phenomenal, but if you look at it over, instead of 3 months, 6 months, it's pretty much, we haven't gone anywhere too special.
Yeah, basically flat, right?
Yeah.
And that's funny because that's every time someone presents me with data like that in a meeting where they go, we're up these massive numbers, I go, talk to me about the previous quarter. Talk to me about the previous thing, because I bet you it was a drop.
Yeah, for sure. So I think there's a couple of really good learnings within here. So the first one is not reacting to the news.
Yeah.
So there was those people, when the markets dropped, there was some panic out there. If you sold at that point because you're like, well, we're coming into another recession, you would have lost 20% of your capital. And it's just the saying, we do not try and time the markets, it's time in the markets. That's point number one. Point number two is the saying, and Warren Buffett, for all the great things he's done, one thing he's done really poorly is just the tip around just invest into the S&P 500 and leave it alone. You can see that strategy is not working this year to date. The other piece, if I bring up my second graph of the day, you can see the medium-term expectations for different regions of the world with their equity markets. So the US is lagging significantly behind Europe, Japan, UK, Australia, New Zealand, developed markets, emerging markets. They're all far behind. And that is just the idea that at some point, P to E ratios, price to earning ratios do matter. And a lot of these US stocks are valued really high compared to other parts of the world like New Zealand, Australia, the UK, Europe, where there is some more upside in these markets.
Do you think any of that forecasted performance as well comes back to the growth trajectory of the American economy, given the uncertainty around Trump, the large amounts of debt that they're carrying, and kind of their seemingly inability to change course?
Yeah,
because it does seem like they're on they're on some train tracks and nothing can change. Otherwise, the whole thing kind of falls apart a bit.
For sure, there's geopolitical risk, there's inflationary risk. The US has just had quite a few years of good performance in terms of GDP growth. There's risk.
Yeah. And it's with that geopolitical risk, I was listening to something the other day where they were talking about, traditionally they ally with these countries. Somehow, in his last term, he was like, I want to now ally with the other countries. So he's pissed off all those countries. Now he doesn't want to ally with those countries. And it's just more isolationist policies over time are going to impact the United States economy negatively.
Yeah, and it's not saying the US is a bad economy to invest into.
Still great.
Like, there's a lot of upside. It just should not be the only economy that you invest into.
Yeah.
So where I want to move now, Mike, is to talk about the individual performance of different asset classes, because it is quite interesting. We've got a range from, markets dropping, some areas dropping 2% to growth of 10% in a quarter. And we're going to talk about those numbers after this break. Are you making investment decisions, maybe a DIY investor, and going, where is this all really going? Well, the answer is you might need a financial plan. We give independent investment advice backed by a research house with long-term financial projections. If you want to have a chat about your situation, click the link below. Now, back to the episode.
Not everything in a portfolio performs homogeneously. Sometimes things outperform stuff. Sometimes things are good one quarter, terrible the next quarter. James, talk to me about some of the individual performers in the portfolios.
Okay, let's bring up the graph. So we've got some interesting numbers. New Zealand listed property is up 7.1% for the quarter.
No.
Yes. Global listed infrastructure is up 6.5% for the quarter.
Yeah.
You might be like, why is that happening? It's really simple. It's all about interest rates.
Yeah.
That's how these assets perform. You might be like, why has that not linked towards my residential property portfolio? Mike, it's probably demand, supply, and just the sentiment of how people are feeling at the moment.
Oh, absolutely. And the other thing as well is how these assets perform like a global market, a global stage, can be very different to how things perform for a residential person in New Zealand.
Absolutely. So the next component is around shares. So Australasian shares is up 7.4%. Global equities that are growth stocks is up 9.8%. They're probably the big two to talk about. Emerging markets up 4.5%. Small cap stocks up about 4.1%.
Yeah.
Now you might go, they all sound great numbers for a quarter. Year to date, calendar year to date, they're pretty much flat.
Yeah.
But Mike, what I was keen to do today was talk about within those numbers, there are growth stocks, value stocks, and small cap stocks.
I was just about to ask you about this. Every time you sink into a little bit of jargon, I want to clarify it for the listeners, right, and our investors. So run me through those three asset classes. What actually are they?
Yeah, so a growth stock, like probably a lot of the tech stocks are a perfect example where they're growing faster than average. They often reinvest any profits or potentially losing some money.
So no dividends?
Yeah, so think Apple or Tesla, they might be a bit more risky or expensive and volatile, but you are thinking their future potential, they are on the rise. That's how to think about a growth stock.
So they're really good if you don't need kind of dividends, I guess, or a regular income stream from your investment portfolio?
Yeah, or you're, for lack of a better term, taking a bit of a punt. They're probably the ones where, like the OpenAI, the Teslas, where you may not have all the information, you may not be doing a lot of research. They're probably some of the ones that people draw themselves to. Generally speaking, what I find is those who, this is going to be a very dangerous statement, those who don't really know what they're doing will pick those. Those who are trying to build a well-constructed portfolio are potentially underweighted in some of these right now just because of how much they've moved over the past few years.
And do you think that's because those growth stocks are more exciting? There's more news about them. They're in the media, so people go, oh, that must be a good investment for me.
100%.
Yeah. And you'll notice there where I said, that must be a good investment for me. What I didn't say was that must be a good investment, because these are good investments for some people in some portfolio, but is it a good investment for you?
Yeah, so let's move on to value stocks. So these are companies that appear undervalued or cheap based off fundamentals.
Lighthouse mortgages.
Lighthouse wealth.
Yeah.
Lighthouse property. Checks and balances. Get back in your life and buy our stock today. They are based on the fundamentals good. So that might be, they might not be particularly sexy or exciting, but they're paying out good dividends. They're in a great industry with some growth, etc.
What are some examples of those?
Banks would be really good examples. Very strong fundamentals, not going anywhere anytime soon. Utilities, much potentially older or established businesses like Coca-Cola, Pepsi, those sort of industries.
Yeah, absolutely.
So they might be cheap for a reason though. So that's probably the risk and potentially lower growth.
Yeah.
So they're probably not as exciting, maybe not as much upside.
If you look at Pepsi and those ones you just talked about, probably looking quite cheap at the moment. But what you've got to think about there are the other factors that are playing on that. Like you've got a shift in consumer trends with the new weight loss drugs that have come out. You've got some executional risk with Pepsi as well. So again, just because something looks cheap and it's a long-term company, again, doesn't mean it's a good investment for you.
Cool. Last one is small cap stocks. So the name is on the label. They're smaller companies. So they're usually earlier in their growth journey. They can grow fast, but if they're small, they might also fail fast.
Yeah.
So the idea is they're going to be more volatile, risky, but with potential for higher returns. So pretty much they're like investing in closer to a startup than a giant corporation.
Yeah.
So some people like investing into small caps.
Yeah, cool. So those are probably some of the more jargony areas of the portfolio. James, what's next?
Let's talk about and bring up the next graph, please, Em.
Great.
Our
One more graph, you
5-year
lucky
return
listeners.
numbers. So this is a really cool one to see where we're not just looking at 3 months, but we're looking a year, 3 years, and 5 years, and what has performed really strong.
Yeah.
Pretty much cash and bonds have just had a horrible half a decade. I mean, the main thing to do with that is interest rates and the movements and going from really low to really high quite quickly has hurt a lot of them. Property over 5 years in these asset classes, not looking great, except for infrastructure, up about 11%. But if you look at shares across the board, really, with the exception of New Zealand, quite strong double-digit returns over 5 years. One interesting point on the New Zealand shares though, Mike, is you look at the 5-year number 2.7 and you go, I wouldn't go anywhere near that. When you do extrapolate it to 10, 15, 20-year performance numbers, they pretty much all average out.
Yeah. Do you see anything in the kind of numbers, data, forecasts that would give people a reason to expect significant growth out of New Zealand in the next 24, 36, 5 months, 5 years at all? Is there anything that you're seeing there where people are like, we're getting double-digit growth over here, we're going to get some stellar years for New Zealand?
I mean, I wouldn't tell people to go out and buy a bunch of like NZ companies, to be honest. But I do believe in the law of averages.
Yeah.
And Go New Zealand's been below average, and I think there's swings and roundabouts, and that will come back at some point.
Yeah, reversion to the mean.
Yeah, 100%. So let's move on to, I've got another graph that I like, Mike. We're full of graphs today. This is if you invested $100 10 years ago,
and checks and
where
balances.
would it be sitting right now?
Yep.
So the first one is if you invest into cash. The blue line in the graph is if you had $100 10 years ago, it'd be now worth about $140.
Look out.
If you invested into a defensive portfolio, which is about 20% shares and property, 80% cash and bonds, that's sitting at $190, so 50% higher over a decade. A balanced portfolio, which is half shares and property, half cash and bonds, $240, so 240% in growth. And a high growth portfolio, which is mainly in shares and property, $295, 295% growth. So it's just interesting to see when people think about volatility, you look, the red line has been far more volatile, the one with mainly shares, than the blue line or the green line. But over the long term, you can see that taking more risk does put you in a better position if you can tolerate it.
Yeah, and with those volatility swings in that graph, what you usually see there are the points where people sell. They'll sell when it's up, they'll sell when it's down, or when it's moving, right? If you're in one of these funds or in this risk class, you've got to be able to tolerate it. There's no point in just looking at those numbers and going, I'd love the $200 option. Give me that one. You've got to be able to sustain that risk.
Some clients go to me, oh, James, we're just going to give you some of our money and then we'll see how it goes.
Yeah.
And I'm like, all right, let's just, because I'm really proud that when markets drop, our clients don't call us because we set the expectations up front really well. And I'm like, all right, so if it drops in value, what are you going to do? And they're like, well, we're not going to give you more money. And I'm like, okay, so if it's cheaper, you're not going to give me more money? They're like, correct. I'm like, okay, if it goes up in value, what are you going to do? We're going to give you more money. And I'm like, okay, so if you're assessing my performance based off what happens with markets, this relationship's never going to work.
Yeah.
Really, if it drops and I lose you money, you should give me more money. And they're like, what is this guy talking about? Okay, so that's kind of like if you invested $100, what would happen? Just for our investment clients at Lighthouse, I just want to talk about a few key numbers. So a defensive portfolio over the quarter to the end of June, up 2.1%. Over a year, up 7.9%, and 5 years, 3.7% because of the performance of those cash and bonds over a 5-year period. For a balanced portfolio, we're up 3.3% for the quarter, 11% for a year, 7.2% over 5 years per annum. And for high growth, mainly shares, 4.9% for the quarter, 13.7% over a year, 10.6% over 5 years.
It's not bad.
So the main thing I would say is for the quarter performance, they look great. If you times that by 4, you'd be very happy. Just remember, the quarter before was pretty much the exact opposite. So it's pretty much neutral over that period.
Yeah.
To summarize, though, my key takeaways that I get you to think about, for those that are holding cash, term deposit rates are continuing to come down. If you have money in the bank, if it's for the short term, that's fine. But if you're thinking about the longer term, I mean, I gave you that example of what happened to $100 in cash over 10 years. You got to think about whether that's the right place for you. There is more news to come with Trump and tariffs. That's not done. There's even some news right now rolling out about it. So we'll see how that plays out. And the last one I'd say, the S&P 500, the US market, while it's an important economy for the world, it is not the be-all and end-all. You want to have a much more diversified portfolio than just that.
Yeah, 100%.
Great. All right, we'll wrap it up there. Much love to Lighthouse Financial for sponsoring this episode. Please subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.